Welcome to this session of Physical Academy tutorial on IAS 36, Impairment of Assets. In this lecture, I will examine reversal of impairment. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, thank you for being part of this channel. Impairment loss is where the carrying amount of an asset exceeds its recoverable amount. That is impairment loss. Impairment loss is where the carrying amount of an asset, the carrying amount is called the net book value of an asset, exceed, that is greater than the recoverable amount. Recoverable amount. Remember, if you have watched my earlier video on IAS 36, I've told you that the recoverable amount of an asset is the higher of fair value less cost to sell and value in use. Higher of fair value less cost to sell and the value in use. An asset is impaired where its carrying amount exceeds its recoverable amount. An asset is impaired where the carrying amount of the asset is higher or is greater than its recoverable amount. Where an asset that has been impaired in the past because its carrying amount is greater than its recoverable amount is subsequently improved. It means where the recoverable amount of an asset that has been impaired in the past now turns out to be higher than the carrying amount. That is where the recoverable amount of an asset, recoverable amount of an asset that has been impaired in the past. Remember, the impairment loss was recognized when the carrying amount of the asset turns out to be greater than the recoverable amount. The asset that have been impaired in the past because their carrying amount was greater than its recoverable amount now turns out to improve. That is, the recoverable amount of the asset now turns out to be higher than the carrying amount. Where the recoverable amount of an asset that has been impaired in the past now turns out to be greater than the carrying amount of the asset. That means the impairment loss on such asset that has been granted will need to be reversed. That is what we mean by reversal of impairment. Remember, when the impairment loss was recognized initially, because the carrying amount of the asset was greater than the recoverable amount, then the double entry is to debit the profit or loss and credit the asset. The profit or loss has been debited and the asset has been credited. That was the double entry that was passed earlier, because the carrying amount of the assets was greater than its recoverable amount. Now, the asset which has been impaired now is now having the subsequent recoverable amount in the future. The recoverable amount of the asset in the future now turns out to be greater than the carrying amount. So the carrying amount, the impairment loss previously recognized will need to be reversed. To reverse it means you will debit the asset in order to increase the value of the asset. Now, you want to increase the value of the asset, you now credit the profit or loss. And where the impairment loss has earlier been treated as a revaluation offset, remember, the revaluation will have been debited and the asset credited. So where that is the case, the impairment loss reversal or the reversal of impairment will need to be debited to the asset account and credit the revaluation surplus. So that is the double entry. Remember, where an asset is impaired, we said the double entry is to debit profit or loss and credit the asset account with the impairment loss. And if the impairment loss was treated as a revaluation offset, the double entry would have been to debit revaluation surplus. Revaluation surplus and credit the asset account with the impairment loss. With the impairment loss so recognized. That is the double entry to make when an asset is impaired. But the asset that have been impaired in the past, I've told you the value improve in the future. And I've told you where the future value of the asset improves. That means the impairment loss that have been granted will need to be reversed. And that is called reversal of impairment. Reversal of impairment loss. The double entry you will need to pass is to reverse what have been done earlier. And to reverse that, so that means the asset that have been credited is what you will need to debit. Debit the asset. Debit the asset account. And you credit the profit or loss. Profit or loss with the reversal of impairment loss. So you want to reverse it. You want to increase the asset since the asset has been reduced. When the asset was impaired, the asset has been reduced. You need to increase it when the impairment loss are reversed. So that is why to increase the asset, you debit the asset account. Then the profit that has been reduced, when the impairment loss was recognized, then you will need to credit that profit. That is why we are crediting the profit or loss. And if that double entry was made to revaluation reserve, then that means you debit the asset account, you credit revaluation surplus. Revaluation surplus. That is the double entry you need to pass when the impairment loss are reversed. Reversal of impairment loss. Reversal of impairment. So that is the double entry you need to have passed. That is the treatment of reversal of impairment. Indicators of impairment reversal. What are those conditions that will tell you that the impairment loss you have been granted in the past has now been reversed? What are the conditions or what are the factors that will indicate that the value of the asset has been improved? So those indicators, we will categorize them into two. We have the external indicators of impairment reversal and internal indicators. So what are the external indicators of impairment? External indicators of impairment reversal. What are the conditions outside the entity that indicate that the impairment loss that have been granted in the past has now been reversed? Number one is increase in the asset market value. Increase in the asset market value. Where the market value of the asset has increased, that is a condition that the value of the asset has been improved. If the market value of the asset has increased, if it's now worth more than what it's actually worth in the past, that is a condition that the value of the asset has been improved. In that case, the impairment loss you have granted on such asset in the past will need to be reversed. Number two is decrease in interest rate. Decrease in interest rate. Remember, the lower the discount factor, the higher the present value calculated without discount factor. And the higher the discount factor, the lower the present value calculated with that discount factor. Since the interest rate will be used as the discount factor to use in calculating the present value of the future cash flows, which will give you the value in use of the asset. In that case, if this interest rate used, if it is lower, if it decrease, then that means the present value would increase. Where the present value increases, that means the value in use will increase. And where the value in use of the asset is higher, remember we said the recoverable amount is higher of fair value, less cost to sell and value in use. If the value in use is higher, then the recoverable amount of the asset will be expected to be higher. So where the recoverable amount is higher, that means the impairment loss you have granted in the past will need to be reversed. So that is decrease in interest rate. Number 3 condition, we are looking at external indicators of impairment reversal. Number 3 is favorable changes in the technological, market, or economic or legal environment. Number 3, we have favorable changes in the technological, favorable changes in the technological, market, economy, or legal environment, Where there are positive improvement in technology, that means the asset will be expected to work more than before. Where the legal environments that affect, where they have positive impact on the asset, that means the value of the asset will be expected to increase. That means the asset will worth more than before. And if assets worth more than before, that means the recoverable amount of the asset will be higher than its carrying amount. And where that happens, then that means the impairment loss you have granted in the past may need to be reversed. Number 2, we have internal indicators of impairment reversal. What are the factors within the entity itself that shows or that indicates that the value of the asset may have improved? What are the factors within the entity itself that will indicate that the impairment loss that have been granted in the past needs to be reversed? Number 1, we have favorable changes in the use of the asset. Favorable changes in the use of the assets, where the asset usage is no longer as bad as it was in the past. That means the asset value may be increased because there will be less damages to the asset. So the asset will no longer damage as it used to be before. And where there are less damages to the asset, then the asset value would improve. So that is favorable changes in the use of the asset. Number 2, we have improvement in the asset economic performance. Improvement in the assets economic performance. Where the asset now perform better than before, that means the asset value have improved. The performance of the asset have improved. And where the performance of the asset improves, then that means the asset value would improve. And where the value increases, then that means the impairment loss you have granted in the past may need to be reversed. We want to consider the conditions for reversing the impairment. So reversal of impairment loss. Impairment loss. So reversal of impairment loss. Number one, impairment loss on goodwill cannot be reversed. Impairment loss on goodwill cannot be reversed. Why? Remember, we don't use to recognize internally generated goodwill in the financial statements. So if goodwill has been impaired in the past, and if the value of the goodwill subsequently increase, that means the reason why the value of the goodwill have increased might be as a result of internally generated goodwill. And where that happens, we don't use to recognize it in the financial statement. As a result of that, so you don't need to reverse the impairment loss on goodwill you have granted. Number two, the impairment reverse must not exceed the impairment loss previously granted. The impairment reversal, the reversal of impairment loss impairment loss must not exceed the impairment loss previously granted. Even where the recoverable amount, let's assume you have granted 2,000 as impairment loss, and the carrying amount was 20,000, and the recoverable amount now turns out to be 50,000. So you cannot say the difference between carrying amount of 20,000 and the recoverable amount of 50,000 is 30,000. As a result of that, you now want to reverse 30,000. That is not possible, because the amount you have granted in the past is just 2,000. The impairment loss you can reverse must not exceed the impairment loss you have granted in the past. Please bear that in mind. Number three, impairment reversal should be treated as an income in profit or loss. Three, impairment reversal should be treated as an income in the profit or loss. That is, the amount you want to reverse as an impairment, you will treat that as an income. That is why I said you debit the asset and you credit profit or loss. That means you are now treating it as an income. With the reversal of impairment, you treat it as an income in the profit or loss. If the original impairment was charged against revaluation surplus, if the impairment loss that had been granted in the past, if it was charged against the revaluation surplus, then the reversal of impairment should be credited to the revaluation surplus. That is, if the impairment loss you have granted in the past, if it were not debited to profit or loss, if it were earlier debited to revaluation surplus, that means the amount you want to reverse should be credited to revaluation surplus. So in that case, you debit the asset account, you are debiting the asset account in order to increase it, you credit revaluation surplus. With the with the reversal of impairment loss. With the reversal of impairment. Procedures for calculating. Procedures for calculating the amount of impairment loss to reverse. One, calculate the impairment loss upon the first impairment review. Calculate the impairment loss upon the first impairment review. Calculate the impairment loss upon the first impairment review. Calculate the carrying amount of the asset at the date of the latter impairment review based on the current recoverable amount of the asset. Calculate the carrying amount of the asset at the date of the latter impairment review based on the current recoverable amount of the asset. 3. Calculate the carrying amount of the asset at the date of the latter impairment review based on the depreciated historical cost. 3. Calculate the carrying amount of the asset calculate the carrying amount of the asset at the date of the latter impairment review based on the depreciated historical cost. That is as if the impairment loss never happened. That is as if the asset never impaired. As if the asset is never impaired. Number 4, you compare the two carrying amounts to determine the amount of impairment loss to reverse. Compare the two carrying amounts. That is the carrying amounts at the step 2 and the carrying amount at the step 3. Compare them. Compare the two carrying amounts in order to ascertain the amount of impairment loss to reverse. These are the procedures you need to follow when calculating the amount of impairment loss to reverse. Example, Buster purchased a non-current asset on 1st of January 20X1 at a cost of $30,000. At that date, the asset had an estimated useful life of 10 years. Buster does not revalue this type of asset, but accounts for it on the basis of depreciated historical cost. At 31st December 20X2, the asset was subject to an impairment review and had a recoverable amount of $16,000. At 31st December 20X5, the circumstances which caused the original impairment to be recognized have reversed and are no longer applicable, with the result that the recoverable amount is now $40,000. Required. Explain with supporting computations the impact on the financial statements of the two impairment reviews. This question is obtained from Kaplan ACCA study test, strategic business reporting, and the same question is in Kaplan ACCA study test, financial reporting. That means the question is obtained from SBR and FR ACCA study test by Kaplan. Solution to the question. The name of the entity is Buster. Buster purchased a non-current asset on 1st of January 20X1. So, in 20X1, 1st of January 1st, we have the cost. And the amount is in US dollar at a cost of $30,000. The cost of acquisition is $30,000. At that date, the asset had an estimated useful life of 10 years. The estimated useful life of the asset is 10 years. Buster does not revalue this type of asset, but accounts for it on the basis of depreciated historical cost. At 31st December 20X2, the acquisition is January 1, 20X1. It means for the year ended, as at the end of January, by January, depreciation will be recognized in the financial statement. That means the asset will have been depreciated for 1 year by December 20X1. Then at December 20X2, the asset was subject to an impairment review. By December 20X2, another year depreciation, making 2 years depreciation. One depreciation at December 20X1, another depreciation at December 31st, 20X2, making 2 years depreciation. The asset was subject to an impairment review and had a recoverable amount of $16,000. So you will need the carrying amount of this asset as at December 31st, 20X2. So we have 20X2 now. Let me calculate depreciation on a yearly basis. So by December 20X1, December 31st, you have depreciation. We were told it have estimated useful life for 10 years. So we had depreciation of 30,000 divided by 10. That means depreciation of 3,000 will have been recognized in the financial statement as at December 31st, 20X1. So that means as at December 31st, 20X1, you will be having the carrying amount of 27,000. That is 30,000 minus 3,000. Then you have 27,000. Then you have another year, 20X2 again, which is the second year of the asset. Remember, the asset was reviewed for impairment at December 31st. So that means by December 31st, 20X2, another depreciation will be charged. Now, since this asset have life of 10 years, then 20X1 is gone out of 10 years life of the asset. Out of 10 years, 20X1 is gone. Then you are left with 9 years. Therefore, depreciation based on 9 years now will be 27,000 divided by 9. That gives us 3,000 as well. It means in the second year of the asset, then you'll be having the carry amount of 24,000. If you subtract 3,000 from 27,000, that is as at December 31st, you have the carrying amount of 24,000. It is at this date that the asset was reviewed for impairment, which is December 31st. And as at that date, you were not having the recoverable amount. That is, as at December 31st, you have the recoverable amount to be 16,000. If the recoverable amount as at December 31st, 20x2, you have the recoverable amount to be 16,000. If you subtract 16,000 from the 24,000, then you have difference of 8,000. That means the asset has been impaired by 8,000. So you have impairment loss of 8,000. The double entry will be to debit the profit or loss as an expense. Then you credit the asset. That is the double entry for this 8,000. So you debit profit or loss with $8,000, being the impairment loss recognized for the year, and credit the asset, non-current asset. Non-current asset with the same amount, that is 8,000. That is the double entry for this impairment. That means the profit has been reduced by 8,000 and the value of the asset have equally been reduced by the same amount. At 31st December 20x5, the circumstances which had caused the original impairment to be recognized have reversed. So the circumstance that brings about this impairment loss of $8,000 has been reversed and are no longer applicable. That circumstance no longer exists, with the result that the recoverable amount is now 40,000. If you look at the recoverable amount now, it have increased to 40,000. So if you look at the step, I told you the first step is to calculate the impairment loss upon the first impairment review, which has been calculated. Then the second step is to calculate the carrying amount of the asset at the date of the latter impairment review. The carrying amount at the date of latter impairment review, which is December 31st, 20x5. Now, as at 20x3 now, 20x3, you know, you have the carry amount December 31st, the carry amount, what you had, sorry, this is as at January 1st, that is as at the beginning of 20S3. What you had as the closing balance in 20S2 December will be the opening balance in 20S3 January. So it means the recoverable amount you had, which was 16,000, that is what you will now be having as carrying amount as at the beginning of 20S3. Then as at December 20S3, you will recognize depreciation, which is 16,000. Remember, this asset have a useful life of 10 years, and it was acquired on 1st of January 20x1. 20x1 is gone, 20x2 is gone. That means 2 years is gone out of 10 years. Then you are left with 8 years. So you have divided by 8. Then you have depreciation of 2,000 that will be recognized. If you subtract the 2,000 as at December 31st, 20S3, you have the carrying amount of 14,000. The reason for the reduction in the depreciation, you know, the earlier depreciation was 3,000 and it has now reduced to 2,000. This is a change in accounting estimate which will be applied prospectively. This is not a change in accounting estimate. If it were a change in accounting estimate, that change would have been applied retrospectively. Now, so the depreciation reduced because it is the estimated amount that has been reduced. Then in 20x4 now, which is another year, then December 31st, then you have depreciation of 14,000. Remember, you have 8 years here. That means you are left with 7 years now, divided by 7. So then you have 2,000 recognized as depreciation. Then, as at December 31st, you have the carrying amount of 14,000 minus 2,000. That will be 12,000. Then, before you enter another year, which is 20x5. So, in 20x5, as at December 31st, 20x5, another depreciation will be recognized. Why are we still calculating depreciation for 20x5? Because the impairment review happened as at December 31st. So it means the carrying amount you need is the carrying amount as at December 31st, 20x5, not the carrying amount as at January 20x5. So this would have been the balance as at January, no 20x5, because the closing balance in 20x4 will be the opening balance in 20x5. So that means you have this as the opening balance in 20x5. But the 20x5 depreciation will still need to be calculated because the review took place as at the year end. So we have depreciation for 20x5 now. So which will be 12,000. You have 7 years. That means the unexpired life becomes 6 years divided by 6. So you have another 2,000. So if you subtract 2,000 from 12,000, then you have the 10,000 as carrying amount. That is as at December 31st, 20x5. So you have the carrying amount of 10,000. Now, as at that date, you now have the recoverable amount to be 40,000. That is what you have as the recoverable amount as at December 31st, 20x5. So recoverable amount, and that amounted to 40,000. If you subtract that, so we cannot say the amount of impairment loss we are going to reverse will be 30,000, because if you have this minus this, it will be 30,000. We cannot reverse 30,000. Why? Because the impairment loss you have granted earlier was 8,000. Remember, I've told you that the impairment loss you can reverse must not exceed the impairment loss previously granted. The amount you have granted in the past was 8,000. So, and if you look at the difference between the carrying amount of 10,000 and 40,000, so you see that this, you'll be having 30,000. I've told you can reverse more than what you have granted in the past. So in that case, you will need to follow the step number 3. The step number 3, I've told you, you calculate the carrying amount based on the depreciated historical cost. By depreciated historical cost, it means you calculate the carrying amount as if the impairment loss never happened, as if this asset hasn't been impaired. So you calculate the carrying amount as if it hasn't been impaired at all. So you calculate it based on the depreciated historical cost. And you now compare it with this carrying amount. In order to ascertain the amount, you will reverse as impairment loss. 20x3, as at January 1st, you have carrying amount. Remember, if this asset was not impaired, if it was not impaired, this is what you will have had as the opening balance in 20x3, January. So it wouldn't have been the recoverable amount you will have as the opening balance in 20x3. Your opening balance would have been the closing balance in 20x2, which is December 31st, 20x2, which was 24,000. That means the annual depreciation will still remain at 3,000, which you have been charging before. So then we want to have this as the opening balance in 20x3, as if this asset hasn't been impaired at all, 24,000. Then as at December 31st, you have the depreciation will be charged for the year. Depreciation. Remember, depreciation for 20x1, 3,000, and depreciation for 20x2, 3,000 has been charged. Only 2 years depreciation have been charged out of 10 years life. So you'll be having 24,000 being the carrying amount, divided by, out of 10 years, 2 years have expired. Then you are left with unexpired life of 8 years. How did we get that 8 years? The economic life is 10 years, 20s1 is gone, 20s2 is gone, making 2 years. Then you are in the third years now. Only 2 years is gone. 2 years have expired. So that is why you have 24,000 divided by, if you subtract that 2 years from the 10 years life, then you'll be left with 8 years. 24,000 divided by 8, that gives us 3,000. That is the amount of depreciation you will charge in 20x3. Then as at the December 31st, 20x3, you have the carrying amount 24,000 minus 3,000, that will be 21,000. Then you enter another year, 20x4. So as at December 20x4, you will charge another depreciation, which is 21,000. Out of 10 years, 3 years has expired. The unexpired life is 7 years. The 3 years are 20x1, which is the year of acquisition, 20x2, and 20x3. Those 3 years have expired. You are left with unexpired life for 7 years. If you remove 3 years from 10 years, you'll be left with 7 years. 21,000 divided by 7, that will be 3,000. So if you subtract 3,000 from 21,000, you'll be left with 18,000. That is the carrying amount as at December 31st, 20x4. You have the carrying amount of 18,000. Then the next year is 20x5. 20x5. So as at December 31st, 20x5, you have depreciation, which is 18,000. Remember, the life is 10 years. Out of 10 years, 20x1 is gone, 20x2 is gone, 20x3 is gone, 20x4 is gone. That means 4 years have expired. So you are left, if you subtract 4 from 10, then you'll be left with the unexpired life of 6 years. So 18,000 divided by 6, that gives us 3,000. If you subtract 3,000 from 18,000, then you will be having 15,000. This 15,000 is the carrying amount as at December 31st, 20x5. Carrying amount based on the depreciated historical cost. So if it is based on depreciated historical cost, you are having the carrying amount of 15,000. Then, but based on the if the impairment loss has been granted, as at December 20x5, the carrying amount was 10,000. But if there is no impairment, the carrying amount was 15,000. Without impairment, the carrying amount is 15,000. With impairment, the carrying amount is 10,000. How much will be the impairment loss that will be reversed? So we have reversal of impairment. The amount you will reverse. So you have December 31st, 20x5. 20x5 as at December 31st, the carrying amount based on the depreciated historical cost. So you have the carrying amount to be 15,000. But if the impairment loss has been granted, then the carrying amount will be 10,000. So now, comparing the two carrying amounts now, so you have as at December 31st carrying amount. That is if the impairment loss has been granted. You have 10,000. So you have the difference will be 5,000. This 5,000 is the amount you will reverse as impairment. Reversal of impairment. You can't reverse up to 8,000. You can reverse up to 8,000 based on this question. So the double entry for this 5,000 is to debit the asset. You debit the asset, the non-current asset with $5,000. Then you credit the profit or loss. Profit or loss with $5,000. That is the double entry for that. This marks the end of the solution to this question. Please drop the love emoji, like the video, and also share it with others. Thanks for watching ACCA.